Welcome back to the deep dive. Our mission today is very laser focused. We are analyzing a high stakes, high velocity play for industrial consolidation.
That's right.
We are diving into QXO, trading under the ticker QXO, and really analyzing one of the most ambitious corporate roll up strategies we've seen in, well, probably a decade.
This deep dive is absolutely necessary because what QXO is executing is this high-velocity rinse, wash, repeat strategy.
Right.
And they're aiming to build a $50 billion revenue leader in the, and this is key, the deeply fragmented building products industry.
50 billion is a huge number.
It's massive, but its success hinges entirely on Brad Jacobs' ability to apply an AI-first playbook. I mean, a truly 21st century technological approach to double the profitability of these inherently low-tech legacy physical assets.
And all of that while the macro environment is, to put it mildly, volatile.
Exactly.
Okay, let's unpack the central conflict immediately, because what I'm seeing is a known, almost legendary blueprint being applied to a brand new target. The market is betting on the history here.
It is.
So is this simply the next iteration of the incredibly successful Jacobs playbook?
Yeah.
You know, the one that built giants like United Rentals and XPO?
Yeah.
Or is the integration risk in this vast $800 billion fragmented industry just too immense to manage, even for this famously disciplined team?
That is the core question you need to be asking. And look, the market has already spoken to some extent.
How so?
The stock currently trades at higher multiples than many of its industry peers.
Ah, okay.
And that's the immediate manifestation of what we call the Jockey Premium. It's this faith that Jacobs' history basically guarantees success.
So the premium isn't for the assets, it's for the person running them.
Precisely. The question isn't if he can create value, but how much value is left to be created through operational excellence and this tech infusion that justifies the premium valuation today.
To understand that potential, I think we have to start with the man who sets the pace.
You have to.
Brad Jacobs. He's arguably one of the most successful serial entrepreneurs of his generation, known for spotting these huge macro trends and then just ruthlessly executing M&A to consolidate them.
That's the playbook.
For those who may only be loosely familiar, give us the full scope. Just how deep does this history run?
Well, Jacobs is a seasoned CEO who has built 7, going on 8, billion-dollar companies throughout his career.
7.
It's an almost unparalleled track record. It begins way back in the 1980s with Amerix Oil Associates. Then he moved into waste management, founding United Waste Systems.
Right.
He expanded that rapidly through acquisition before selling it for $2.5 billion. But I think the defining moment for many investors, the one they all point to, came with United Rentals.
That's the legendary story, isn't it? The speed of scale he achieved there was just breathtaking.
It was. He founded United Rentals and, using this massive acquisition strategy, turned it into the largest equipment rental company in the world.
And how long did that take?
Just 13 months.
13 months.
He was consolidating a deeply regionalized, fragmented market at, just breakneck speed.
And the legacy of United Rentals for shareholders is, well, it's nothing short of iconic. It's the example investors use when they talk about exponential value creation.
Absolutely. The United Rentals stock became a true 100-bagger.
Wow.
To put that in perspective for you, the share price at inception was around $3.50. Today, it trades at over 100 times that original price.
That's the kind of long-term value creation he's chasing.
Exactly. And after that came XPO Logistics, which he successfully built, and then split into 3 separate publicly traded companies, GXO, RXO, and the original XPO.
So this sequence is clear. Identify a fragmented industry, consolidate it at speed with M&A, integrate and optimize it with technology, and then potentially split the company for maximum shareholder value.
That's the proven blueprint.
But you know, in an era where capital isn't as cheap as it was in the late 90s or the post-financial crisis era, what is the core operating philosophy that still ties all these successful ventures together?
It really boils down to 2 main philosophical pillars that seem to transcend market cycles.
Okay.
First, he emphasizes the critical importance of getting the major trend right. For Jacobs, technology, specifically digitization and now AI, is the dominant megatrend.
So you're swimming with the current.
Exactly. His view is that if you align yourself with the correct long-term secular trend, you can afford to make mistakes in other operational areas and still do exceptionally well.
That makes a lot of sense. Ride the wave. What's the second pillar? It's a bit more counterintuitive, I think.
It is. The second pillar is his profound philosophical shift. viewing problems as assets.
Problems as asset.
He actively seeks out companies, industries, or operational challenges that others are running away from, because those problems represent unpriced value.
I find that concept so clarifying for any entrepreneur or leader listening. It means you don't run away from the chaos.
No,
You run towards the fire because that's where the margin is hiding.
precisely. He learned this early on from his mentor, Ludwig Jesselson, who ran Philip Brothers. And Jesselson's advice was brutally direct. If you want to make money in the business world, you must get used to problems because that is what business is.
It's problem solving.
Success comes from solving problems effectively and profitably. If you see complexity, inefficiency, or chaos, that is not a drain on your energy. That is an opportunity to create value where others have failed.
It fundamentally transforms the entire emotional equation of high-stakes M&A, doesn't it?
It does.
If you are energized by the complexity, if you see fragmented inventory systems or undisciplined pricing as target-rich environments, you are set up to win where others are just, overwhelmed.
It creates a tremendous cultural and competitive advantage. I mean, think about it. Most leaders are drained, exhausted, and slowed down by large, complex organizational problems.
Right, they see it as a headache.
Jacobs and his teams are energized by them. They approach them with analytical rigor, treating them as puzzles that yield substantial returns once solved.
And that energy and entire focus have now shifted almost entirely to QXO. This is key because it defines the current commitment level. This isn't just a side project or board seat for him.
That's right. We saw the definitive leadership transition announced to underline his commitment to QXO. He is scheduled to step down as the chairman of both XPO and GXO on December 15th, 2025.
So a very clear date.
A firm date. And this wasn't a soft retirement. It was a firm commitment to dedicate, and I'm quoting, even more energy to QXO.
Okay.
This confirms his established pattern of going all in on a new massive opportunity roughly once every decade.
Full immersion. His stated method for tackling this is to build what he calls a superorganism,
Right.
which sounds a little like corporate jargon until you break it down.
It does, but it's really about a highly coherent, integrated operating unit where the sum of the parts is significantly greater than the individuals.
And the whole system is obsessively focused on just two metrics.
Two metrics: organic revenue growth
Yeah.
and margin expansion. That's it.
To achieve that level of coherence, that true superorganism, you need exceptional talent density. And this is where his ruthless hiring philosophy comes in.
He is famously rigorous, stating that the CEO's most important job is recruiting superlative people, or genuine A players. He uses a mental check he calls the panic test.
I understand the theory of the panic test. It's if this person quit, would you, the CEO, be in pure terror? And only pure terror qualifies them as an A player.
That's the test.
But let's introduce some skepticism here. Is the panic test truly a recipe for building an A-player team? Or is it a recipe for these high-intensity, high-pressure environments that could lead to burnout, high turnover, especially in a low-margin industrial sector that relies so heavily on stable, long-term local relationships?
That is a very legitimate challenge to the Jacobs model. And you're right, the integration of high-level talent into a low-margin, relationship-driven business like bill and products distribution requires a specific type of cultural change agent.
It does.
If the pace is too fast, the local branch managers, the people who actually know the customers, they might revolt or leave.
So how does he counter that?
He counters this skepticism by focusing on alignment and compensation. The people he hires for the top jobs are not just high performers. They are self-selected for this high-velocity, problem-solving environment.
And we see that philosophy reflected directly in the key strategic hires QXO has announced, particularly those focused on integrating technology where it previously didn't exist.
Absolutely.
Let's look at the specific critical hires that define QXO's future, starting with Ashwin Rao, the Chief AI Officer.
Rao's background perfectly illustrates this blend of theoretical rigor and massive scale application that QXO needs. He came from Target, where he served as the company's first head of AI.
First head of AI at Target.
And crucially, he led the development of these sophisticated mathematical models for core retail functions. Optimizing pricing, merchandising strategy, understanding customer behavior, and refining supply chain logistics at a massive national scale.
And before applying that scale in retail, he was deep in the quantitative finance world, which suggests an incredible level of data fluency and discipline.
Exactly. He holds a doctorate in theoretical computer science, and he spent years as a derivatives trading quant strategist at Goldman Sachs.
Wow.
Then a stint as a managing director of market modeling for Morgan Stanley. That combination, high-level theoretical computer science, Wall Street quantitative discipline, and then large-scale retail implementation, is unique.
It's a rare mix.
His explicit mission at QXO is to make it the most tech-forward company, and by extension, the most operationally efficient company, in the entire building products distribution sector.
So he's bringing a quantitative trading mindset to the pricing of shingles and lumber.
That's the idea.
Now let's look at the second critical hire. Michael DeWitt as the Chief Procurement Officer. Procurement is the immediate lever you pull to generate savings in any large consolidation strategy.
DeWitt brings the necessary operational muscle for that consolidation. He came from Walmart International, where he was the VP of International Spend Management.
Walmart's scale is just enormous.
Think about the volume and complexity of savings required at a company like Walmart. While there, he drove billions in savings and was an early adopter of next-generation AI procurement tech.
Okay.
And that technology helped him more than double Walmart International's annual savings in just 3 years.
So you have the operational discipline of Walmart's global supply chain and the AI quantitative rigor of Target and Goldman Sachs being applied simultaneously.
Right.
This synergy only works because the senior team is heavily incentivized for the long haul, right?
That compensation alignment is the glue that makes the superorganism stick. The core senior team owns a massive 36% of QXO's equity.
36%.
And this ownership comes with explicit lockups extending until January 2030.
30. That is a deep, long-term commitment.
It is. Furthermore, Jared Kushner, through Affinity Partners, invested a significant amount and joined the board, which just reinforces the institutional belief in this long-term time horizon.
That 5 to 7 year lockup window is the time frame for executing the core M&A plan. It forces the team to think like patient owners, not short-term managers.
To the point.
They're literally putting their money where the playbook is.
It creates that true alignment. They feel the pain of a bad decision and the reward of operational success directly in their personal balance sheets. It means they think about the integration risk, the cost of capital, and the long-term customer relationship in a fundamentally different way than a highly compensated short-term executive might.
This intense focus on talent and technology sets the stage for the operational transformation, which brings us to the Beacon acquisition.
Right.
This was QXO's first major move, and it's where they are currently proving or disproving the effectiveness of this AI-first playbook in real time.
The building products distribution industry is an $800 billion behemoth.
Huge.
And it's characterized by this intense regional fragmentation. We're talking about approximately 7,000 independent distributors in North America alone.
7,000.
And critically, and this is where Jacobs gets excited, the industry lags severely in technology adoption. I mean, we're talking about critical business processes still being managed with pen, paper, faxes, and inconsistent email threads.
And Jacobs selects these industries, the ones that are technologically archaic, precisely because competitors who resist change are, as he calls them, gifts.
They are.
They've left massive, easy-to-harvest margin on the table.
Exactly. When QXO acquired Beacon Roofing, which was already the largest publicly traded roofing company in North America, they didn't just buy the physical assets, they bought the underlying inefficiencies.
And they immediately launched a comprehensive transformation program to capitalize on those inefficiencies.
Right away.
What were the first, most radical structural changes they implemented? I want to know the practical implications of taking a large, established industrial company and applying the superorganism knife to it.
Well, the very first step was radical organizational flattening. They immediately streamlined the organizational structure from 9 distinct layers to just 4.
9 layers down to 4.
Yes. And this is more than just an HR exercise. It's an attempt to fundamentally increase accountability, dramatically speed up decision-making, and remove layers of bureaucracy that had become, repositories for confusion and delay.
9 layers suggests enormous complexity. I'm imagining a regional VP, district managers, several layers of branch supervisors, inventory managers, and so on.
All filtering information.
Right. So cutting 5 layers means massive accountability shifts and likely significant staff redeployment or reduction in middle management. Did they face cultural resistance?
Oh, of course. That degree of restructuring causes cultural friction, especially when local autonomy has been high for decades.
So what's the goal?
Jacobs' strategy is to eliminate those middle layers that historically slowed down communication between the corporate center and the front line, the people actually serving the contractors. The goal is speed.
Right.
If a decision needs to be made on pricing or an inventory transfer, it shouldn't have to navigate 9 different meetings to get approved.
And they didn't rely solely on the C-suite for information, did they? They went directly to the people on the loading docks and in the branches to institutionalize that frontline intelligence.
That's the genius of his operational approach. Jacobs and his team conducted live-stream town halls and surveyed around 3,500 Beacon employees on job satisfaction and their best ideas.
And they asked a very direct question.
The most direct question possible. What is the dumbest thing we are doing?
That raw, unfiltered data is gold because, as we know, executives often hide bad news to protect their projects or divisions.
What the frontline workers?
The people handling the materials, frustrated by paperwork and constantly apologizing for out-of-stock items, they tell the simple truth.
And that frontline intelligence, combined with the sophisticated data analytics from Ashwin Rao's team, immediately highlighted massive opportunities for margin expansion.
And the most glaring, visible issue, the low-hanging fruit of inefficiency.
It was pricing leakage.
Okay, let's talk about the AI competitive moat they are building, specifically how they're fixing that pricing problem. Because stating Beacon was losing $200 million is one thing.
Right.
We need to detail the mechanism of how that loss actually occurred.
So Beacon was losing an estimated $200 million annually
Mm-hmm.
due to what they called undisciplined discounting.
Undisciplined discount.
This wasn't theft, it was a system failure. Historically, in a fragmented industrial distributor, pricing often relied on manual spreadsheets, historical relationships, regional autonomy.
The good old boys network.
Pretty much. A salesperson, eager to close a deal on a big roof replacement, could manually override the suggested system, price-sacrificing margin for volume, without a centralized mechanism tracking the long-term cumulative impact of those overrides.
So essentially they were buying revenue at the expense of profit because there was no real-time margin dashboard protecting the company's bottom line.
Exactly. It's the antithesis of the superorganism's goal of margin expansion.
So how do they fix it?
To stop this $200 million hemorrhaging immediately, QXO accelerated the rollout of a centralized AI-driven digital pricing platform.
Okay.
This platform uses sophisticated mathematical models, the kind Ashwin Rao built at Target, to set optimal dynamic prices based on inventory, demand forecasting, customer history, and local competition.
And what does the platform do to the rogue salesperson who tries to override the system?
It implements much stricter override controls and margin dashboards. Overrides become transparent and trackable immediately.
So accountability.
It holds branch and district managers accountable for margin performance, not just sales volume. The goal is clear: to win market share, not by giving away margin through discounting, but by being reliably in stock, quoting quickly, and delivering on time. All things the AI enables.
That $200 million fix, if executed successfully, is an immediate, massive alpha generation metric tied directly to applying technology to a manually managed, broken process.
And beyond pricing, they moved to procurement transformation. The historical procurement process was similarly fragmented. Thousands of different regional vendor agreements at different terms, meaning Beacon paid different prices for the exact same products across the country.
So bringing Michael DeWitt's Walmart expertise to bear, what's the immediate strategy there?
Centralizing procurement authority. They are consolidating terms across their top 20 vendors, which account for roughly 70% of their total spend.
70% from just 20 vendors.
Right. So they are eliminating those thousands of fragmented vendor agreements, using the combined scale of the new company to demand better pricing.
And they're leaning into the AI here too, right? This isn't just about human negotiators.
Absolutely. They are leveraging technology, specifically deploying bots and other automation tools for some of their procurement negotiations, especially for long-tail items or standard contract renewals.
So that just drives down the cost structure efficiently.
Across the entire organization, it reduces labor and achieves a consistency in terms that was previously impossible.
Okay, so shifting from margin expansion to revenue growth, QXO is using AI to proactively hunt down lost customers in a department they call the win room.
Right.
This sounds like military intelligence being applied to roofing contractors. What is the precise function of this agentic AI?
The Win Room is a national call center established specifically to reactivate dormant accounts and capture new customers at scale.
Okay.
The Agentic AI, which refers to machine learning models that can execute complex tasks autonomously, is deployed to identify and target lost or dormant accounts.
Let's define dormant.
Yeah.
What data points does the machine learning model analyze to classify an account as a high-priority dormant account?
It looks at several factors. First, transaction history.
Yeah,
When was the last order placed and what was the volume?
makes sense.
Second, product mix. Did they suddenly stop buying high-margin materials? Third, demographics and timing.
Okay,
Is the contractor still active in the region?
okay.
The AI cross-references this with external market data, and then it flags specific accounts. They identified about 35,000 potential accounts,
35,000.
which are essentially low-hanging fruit for revitalization because they used to do business with Beacon but stopped for some reason.
So the AI finds and prioritizes the targets. Then what does it do for the human hunters, the salespeople on the front line in the win room?
It equips them with instant tools for quoting and winning contractor bids. So when a hunter gets a lead from the AI, they have immediate access to personalized pricing, real-time inventory checks across the entire network, and rapid quoting engines.
So speed and information.
This combination of intelligent targeting and tool enablement is already delivering double-digit productivity gains. Salespeople are able to process more bids and close more deals faster than their regional counterparts operating on old systems.
And crucially, QXO is aligning incentives with profitability, making sure these new sales stick to the margin goals.
Correct. They are refining the entire incentive structure, with new compensation plans launching in 2026 that link pay to profitability as well as volume.
So you prevent the old behavior.
It prevents the undisciplined discounting and rewards the closing of high-margin business, reinforcing the central mission.
Okay, finally, let's cover the foundational fixes inventory and logistics. This sounds like the least glamorous part of the operational story, but it's arguably the most critical for customer retention.
It absolutely is. This goes back to a core operational problem discovered at Beacon, the frustration you often hear from contractors, the lack of critical product availability. Jacobs calls this the cardinal sin in distribution.
Because if a contractor shows up to a site and the critical materials aren't there, they lose time, and time is their most valuable asset.
Exactly. The discovery was stunning. 4% of SKUs drive a massive 80% of sales.
Wow, the old 80-20 rule.
But even more extreme, these are the critical A-level fast-moving items like popular shingles or waterproofing membranes. Yet these critical items were frequently out of stock at regional branches.
A huge no-no.
Jacob said if you want to turn a current customer into a former customer, just keep telling them you don't have what they want.
So the fix requires technology layered over better physical logistics management.
Precisely. QXO is deploying machine learning, demand forecasting, and inventory optimization tools to ensure those A-level items are always in stock in every branch.
And it's based on predictive models.
Based on projected local demand, seasonality, even weather patterns. They're also modernizing their transportation management system, their TMS, to optimize routing and scheduling across the network.
What does that do?
It reduces expensive, profit-draining interbranch transfers.
Interbranch transfers are a massive hidden cost, right? If one branch has to drive a forklift onto a truck and drive 50 miles to pick up materials another branch should have had in stock.
You destroy your margin quickly. It burns cash, time, and labor. The TMS modernization minimizes that.
So the overall takeaway for the operational edge is clear. They are turning an inefficient, low-tech operation into a coherent, high-speed logistics machine, a true superorganism.
And using proprietary AI as the fuel for both margin and revenue expansion.
Okay, shifting gears now. Technology is necessary, but the market structure must be aligned to support this growth. Why is the building products distribution market the perfect vehicle right now, especially given the current macroeconomic volatility of high interest rates and inflation?
Well, Jacobs is masterful at filtering for industries that are protected from major disruptions and aligned with durable, long-term structural trends.
Right.
And QXO sits right in the middle of a massive structural demand foundation that provides a massive built-in moat.
Let's quantify that structural need, starting with the aging stock problem.
The structural need for repair and replacement is massive, regardless of new construction starts. The average U.S. single-family home is now over 40 years old.
40 years.
And the average commercial building is approximately 50 years old. Think about what fails on a 40-year-old home. The roof is definitely due for replacement. The windows are inefficient. The exterior siding is deteriorating.
So we have a mandatory maintenance mandate. Whether we are building new or not, we have to maintain the existing enormous infrastructure we already have.
And that includes true national infrastructure. There is a projected need for more than $2 trillion in North American infrastructure spending over the next 2 decades to address aging roads, bridges, and tunnels.
So that provides long-term cycle-agnostic demand for many of QXO's non-roofing materials as well.
It does.
But the genius of QXO's model, particularly since the Beacon acquisition, is the structural hedge against interest rate fluctuations, the repair and remodel, or R&R component.
This is their primary defense layer. An impressive 80% of QXO's revenue comes from non-discretionary repair and remodel activity.
90%.
Only 20% is tied to new construction, which is highly sensitive to interest rate hikes and builder sentiment. This 80-20 split makes QXO exceptionally durable.
Explain why R&R is non-discretionary or sticky. I mean, if I need a new roof, can't I just wait until rates drop?
You can't. It's simple physics and insurance. When your roof goes bad, when it's leaking or structurally compromised, you fix it.
It's non-negotiable.
It is a non-negotiable expense, often covered by insurance claims, regardless of the macroeconomic environment or the price of interest rates. And on top of that, high interest rates have created the powerful lock-in effect.
Meaning millions of homeowners are locked into sub-4% mortgage rates from 5 or 10 years ago, and they can't afford to move now.
Exactly. So if they stay put, they inevitably invest in maintaining, improving, and remodeling their current aging properties. This boosts R&R demand and reinforces QXO's primary revenue stream.
So high rates actually help this part of the business.
In a way, yes. If rates were low, people might sell and move, reducing the R&R spend. But because rates are high, they fix what they have, right where they are.
So if the underlying economy slows down, R&R acts as a natural stabilizer.
It does.
And if we add in the effects of climate and weather patterns, you have an even more immediate, though tragic, catalyst for demand.
This has become a structural input for the building products market. The frequency of severe weather events, specifically billion-dollar natural disasters, has quadrupled over the last 20 years.
Quadrupled.
And 2023 and 2024 specifically marked the two-year period with the highest number of these disasters in U.S. history.
That creates immediate, massive demand for roofing and waterproofing products that is non-negotiable and, again, largely insurance-backed.
Making it entirely detached from discretionary consumer spending or the housing cycle.
It is a core demand driver that forces homeowners and commercial property owners to replace materials immediately, providing a crucial, predictable revenue flood for QXO's business model whenever these events occur.
Precisely.
Now, let's tie this back to the broader U.S. political and housing landscape, specifically the push to close that 4 million home deficit. This has become a political mandate across the aisle.
It has. The deficit is a genuine structural issue. The U.S. is short approximately 4 million housing units. This deficit affects affordability, economic mobility, and that makes it a hot political issue.
Right.
We saw, for example, the previous administration publicly urge homebuilders to boost construction, stating they were sitting on 2 million empty lots, and asking government-backed entities like Fannie Mae and Freddie Mac to help spur building activity.
The political goal is simple: restore affordability by increasing supply, which directly benefits QXO regardless of the mechanism used.
Although it's important to note the complexity here. While the political pressure is real, homebuilders and many economists argue that the core constraint isn't necessarily collusion or sitting on empty lots.
Yeah, it's something else.
It's local zoning regulations, excessive red tape in permitting, and high-impact fees that make building prohibitively expensive, especially for entry-level homes.
So regardless of whether the primary bottleneck is regulatory or market-driven, the bipartisan political goal to close the 4 million home deficit provides massive support for long-term demand for QXO's materials.
It does.
They are positioned to benefit from any meaningful legislative or market push to build.
That's the strategic alignment. You have a durable, non-cyclical, demand-driven business model operating in a large, fragmented market with deep structural tailwinds. All of this gives Jacobs the stable platform he needs.
And now he just needs the capital to execute the consolidation blueprint.
That's right.
And that brings us to the financial strategy, the M&A playbook and the war chest. How is QXO structuring its acquisitions, and what is the math behind the immediate value creation?
Jacobs' M&A process is highly rigorous and focused on financial arbitrage. It starts by looking at 55 industries and narrowing down thousands of potential targets to just a few dozen.
And the objective?
It's non-emotional to buy companies at a significantly lower profit multiple, an EBITDA multiple, than QXO currently trades at.
That's the core alpha creation thesis. If you buy a struggling regional distributor at, say, 5 times EBITDA, and by virtue of integrating them into the QXO superorganism, they are immediately valued by the market at QXO's multiple of, say, 10 times.
You've instantly created a 100% return on the purchase price.
That multiple arbitrage is the immediate source of alpha.
Exactly. The strategy is clear. M&A, integrate with AI and operational fixes, rinse, wash, repeat. The ultimate, publicly stated goal is to deploy this process repeatedly to build a $50 billion revenue company over the next decade.
To execute that scale of M&A, you need serious liquid resources. What is their current capital position?
QXO holds a substantial $5 billion cash war chest specifically designated for acquisitions.
$5 billion.
This capital was raised strategically through institutional investors who have historically backed Jacobs' ventures, which reinforces the market's belief in his execution ability. And this includes the investment from Jared Kushner's affinity partners.
$5 billion in available firepower in a fragmented industrial space where most competitors are subscale regional players, that is a massive competitive advantage.
It absolutely locks out the regional players. Jacobs emphasizes that QXO's size allows it to invest hundreds and hundreds of millions of dollars into technology,
The exact AI platforms and TMS systems we just discussed.
which is simply unaffordable for smaller regional competitors who are still running their operations on outdated manual systems. This investment capacity reinforces that technological moat.
But let's introduce the critical balance here. While $5 billion is massive firepower, deploying capital now means QXO is potentially buying in a high interest rate environment. The cost of that capital is higher.
It is.
Doesn't this high cost of capital demand even faster EBITDA growth post-acquisition to justify the purchase price?
It absolutely raises the bar for execution speed. The integration playbook, particularly the immediate fixes like the $200 million pricing leakage, must move quicker than ever before.
Right.
In a low-rate environment, they could afford to integrate over 2 or 3 years. Now, they must aim to double that acquired company's profit, their EBITDA, within 3 to 5 years by ruthlessly applying the transformation playbook.
With that kind of capital, there must be a huge internal sense of urgency to deploy it.
While Jacobs and the team feel an inherent sense of urgency, that proclivity for action we discussed, that does not translate into pressure to overpay. Jacobs views overpaying as the cardinal sin in M&A, calling inflated valuations trophy prices.
So they will truly walk away from a deal if the valuation is inflated, even if the target is strategically perfect or if there's internal pressure to deploy that $5 billion war chest.
That is their stated discipline. They will pay a fair price that allows them to achieve their target internal rate of return, but they maintain valuation discipline. We see this before even at XPO, where they walked away from deals.
Okay.
They also maintain a standing target leverage ratio of only 1 to 2 times, which indicates a commitment to financial prudence and maintaining dry powder.
That discipline, combined with the target of doubling acquired company EBIT within 3 to 5 years, that defines the entire financial architecture of QXO.
And their ability to scale is further aided by the nature of the industry itself. Building products distribution typically exhibits a high 75% EBITDA to free cash flow conversion rate. And why is that?
Because the capital expenditure requirements are relatively low compared to, say, manufacturing or complex logistics hubs.
So the cash flow is strong.
This means that every dollar of profit they generate translates quickly into deployable cash for the next acquisition. The superorganism is inherently self-funding once it hits scale.
Okay, let's bring this deep dive together. We've covered the legendary Jockey, the AI-first blueprint, the operational fixes yielding immediate returns, the durable R&R macro tailwinds, and the disciplined financial firepower. What is the synthesis of the investment case?
The core bullish factors are compelling. You have a proven, decades-refined playbook executed by an A-player team with extreme equity alignment extending years into the future.
Right.
They are targeting a massive, fragmented industrial market worth $800 billion that is technologically vulnerable. And there is an immediate and visible margin expansion opportunity, exemplified by that $200 million pricing leakage fix at Beacon and the highly scalable AI procurement strategy. And crucially, the underlying business structure is defensive, protected from cyclical downturns.
Absolutely. The defensive business model, with 80% R&R revenue, shielded by the lock-in effect, and boosted by unfortunate but predictable severe weather trends, provides a durable hedge detached from typical housing cycle volatility.
And we're seeing signs of this working already.
We're already seeing early signs of traction, with QXO beating both EPS and revenue estimates in the quarters following the Beacon acquisition.
The market, as we noted at the start, is already pricing in some of this future success, reflected in the Jockey Premium. But is the 300x sequential return track record of Brad Jacobs justified by the current valuation, or has the market gotten ahead of the execution?
That is the critical risk-reward question that every investor has to weigh for themselves. The market is betting heavily on flawless integration and the rapid achievement of those target margin expansions.
So it all has to go right.
The intense focus, the high-density A-player team, and the refined toolkit must justify that premium by delivering technologically driven margin expansion and exponential growth through disciplined M&A and structural R&R tailwinds.
Doesn't this M&A strategy, focused on buying lower multiple companies, inherently limit their target pool? If a competitor is already trading near QXO's multiple, they become untouchable.
They do.
Meaning QXO must only focus on poorly managed, subscale players, which carry higher inherent integration risk and more operational chaos.
And that is the ultimate test of the superorganism. You are forced to buy companies with deep-seated problems, the operational chaos that other executives run from.
So we're back to problems as assets.
The critical conflict, ultimately, is whether QXO can truly be the ultimate tech-enabled industrial transformation, leveraging AI and quantification to achieve unprecedented margins in a low-tech space. Or if the sheer scale of building a $50 billion superorganism carries unpriced integration risks.
Especially given the historical complexity of consolidating physical, low-margin sectors that depend on local relationships and physical inventory. Integration and physical distribution is never easy. It's messy, it's cultural, and it's expensive.
It is. But QXO's entire strategy is built around minimizing that risk through aggressive upfront operational fixes, high talent density, and immediate technology deployment, turning what others see as overwhelming organizational chaos into predictable, solvable, profit-generating assets.
They run toward the fire, not away from it.
That's the playbook.
That brings us back to the core philosophy. Brad Jacobs uses the filter, waste of time, waste of money, WOT1, for all decisions.
Right.
Does the action, the hire, or the investment grow organic revenue or expand margins? If the answer is no, it's discarded. Now that you understand this brutal clarity and efficiency, consider applying the WOT1 filter to your own next big decision. Ask yourself, are you addressing a problem that others are avoiding, or are you avoiding the fire? The biggest opportunity in front of you might be the one problem you are running away from right now.